Most people begin the pursuit of money by asking what brilliant strategy they should adopt. It's a flattering question, but it's the wrong one. The clearer question is what foolish decisions they're currently making, and what harm those decisions are compounding. Starting from zero, stupidity is a far more lethal opponent than a lack of brilliance. Wrong moves have a nasty habit of accumulating interest at a rate that no clever plan can overcome. So the first job is to stop the self-inflicted wounds. Avoiding stupidity means declining the distractions that masquerade as opportunities. A person with no money is particularly vulnerable to schemes that promise rapid financial transformation, because impatience is strongest when resources are scarce. But transforming $0 into something meaningful requires discipline long before it requires genius. One must refuse debt that purchases vanity, refuse speculation that flatters greed, and refuse habits that quietly steal future optionality. When you have nothing, optionality is your most valuable asset. The game of economic progress is played on a surprisingly tilted field. If you merely avoid big mistakes long enough, the odds tend to drift in your favor. This is because most competitors eventually sabotage themselves. They overspend, overestimate their abilities, or overindulge in emotional decisions disguised as strategic ones. The person who simply declines to do these things is not competing in the same race. They're observing the other runners collide with avoidable obstacles. Avoiding stupidity is also an exercise in intellectual honesty. It demands that you look at your behavior without sentimentality. If the habits you cling to have not produced desirable outcomes, then the evidence is against them. The rational thing to do is abandon them, even if you feel quite attached. Reality does not bend to emotional preference. Its incentives and penalties are non-negotiable. There is also a moral component here, though it is rarely discussed. A life without unnecessary chaos is a life that accumulates trust, and trust, especially when starting from zero, is a form of capital that you don't have to buy. People extend opportunities, information, and goodwill to those who prove they won't squander them. Reliability is monetizable, though it never shows up on the balance sheet. All of this may sound unglamorous, and it is. Avoiding stupidity doesn't make headlines or impress audiences at cocktail parties, but it creates the silent foundation upon which every worthwhile fortune is built. Progress starts the moment you stop digging holes. Starting from nothing is not a curse. It's simply a position with no cushion for foolishness. The sooner you understand that, the sooner you stop making the kinds of decisions that ensure you remain at zero. When starting from nothing, your most valuable asset isn't money, it's the ability to trade time for skill and skill for opportunity. There's a widespread fantasy that financial escape can be engineered through clever shortcuts, but the enduring path is far more practical. Acquire a skill that other people need, cannot easily replicate, and are willing to pay for. If that sounds disappointingly rational, that's because most effective strategies are. The modern economy is not equally kind to all skills. It rewards those that solve pain points, create value, or reduce risk. It punishes those that are abundant, easy to automate, or pleasant only to the practitioner. A sober evaluation of market demand is therefore essential. You don't have to fall in love with the skill. You just have to become competent enough that people value your output. Passion is optional, usefulness is mandatory. Starting with zero capital sharpens the decision. Your skill must be able to generate income quickly, yet possess a long enough shelf life that mastery compounds. The beginner's error is chasing novelty. The wiser approach is to chase durability. Accounting, programming, sales, writing, copy editing, data analysis, logistics, negotiation, carpentry, plumbing. These are not trend lines, they are infrastructures. The world always needs them. Technology may modify the tools, but demand persists. Learning a marketable skill also offers leverage of a distinctive sort. It converts effort into reputation. As you perform reliably, word spreads, and time starts to work for you rather than against you. A person with no money must learn to recruit time as an ally. Time is the most democratic form of leverage. It compels no upfront investment besides patience. A useful skill also provides a psychological dividend. Competence is the antidote to desperation. Desperation makes people susceptible to predatory deals, bad partnerships, and poor judgment. Competence creates bargaining power. Bargaining power creates choices. And choices allow you to decline the traps that keep most people poor. One must also acknowledge friction. Learning a real skill requires inconvenience, frustration, and repetition, precisely the reasons so few people commit to it. But that scarcity is what makes the skill profitable. Markets do not generously reward activities that are enjoyable, easy, or instantly gratifying. They reward things that are hard, scarce, and useful. Finally, the pursuit of skill compounding has no terminal point. You can get better indefinitely. That means your upside is uncapped. A clever financial trick might double your money once. Expertise can double your earning power for decades. When starting from zero, there is no greater unfair advantage than becoming undeniably useful in a domain where usefulness commands a premium. Beginning from zero naturally tempts a person to imitate those who appear far ahead. They buy symbols of prosperity rather than the ingredients that create it. This confusion between display and substance is one of the most persistent forms of self-sabotage. The habit of delayed gratification is not about deprivation for its own sake. It is the conscious refusal to consume tomorrow's opportunities in exchange for today's applause. Starting with nothing means you must accumulate the raw material of progress, savings, competence, and credibility long before indulging in comfort. Frugality is often misunderstood as stinginess, but they are not the same. Stinginess is merely the refusal to part with money. Frugality is the careful deployment of resources toward maximum long-term advantage. It asks a question that almost no consumer bothers to ask. What is the future return of this dollar if I don't spend it? When money is scarce, every dollar has the potential to either solve a problem or compound into more dollars. Choosing compounding may feel slow, but the slow lane eventually overtakes the fast lane, fueled by debt, impulse, and vanity. The discipline of thrift is not meant to be permanent exile from pleasure. It is a temporary imposition that creates future optionality. The earliest savings are not about retirement or investments. They are about escaping fragility. Money, when you have none, is oxygen. A few months of expenses in a bank account grants the freedom to think rationally, negotiate assertively, and decline bad deals. Without that cushion, desperation becomes the governing principle, and desperation is a terrible financial strategist. The world is built to seduce impatience. Advertising manufactures dissatisfaction, social media curates envy, and credit cards make indulgence frictionless. Resisting these forces requires a degree of self-respect that borders on contrarianism. You must be willing to look unfashionable for a period of time, and you must tolerate the condescension of those who are confusing motion with progress. Their approval is cheap. Financial independence is expensive. Delayed gratification is powerful because it compounds silently. Every avoided indulgence, and every preserved dollar forms a base upon which future investment rests. The mistake most people make is assuming that frugality is the entire game. It is not. Frugality merely creates the seed capital. What matters next is how intelligently that seed is planted. But without the seed, the rest of the plan collapses into wishful thinking. Most fortunes, humble or grand, share an unglamorous origin, a period in which expenses were lower than earnings. That gap, the surplus, is where opportunity incubates. It is the only legal alchemy that turns labor into capital and capital into freedom. Starting from zero means the surplus must be manufactured against resistance, pride, and temptation. But once the habit is established, time joins the effort and the compounding becomes inevitable. Once a basic surplus of time, skill, and savings exists, the next move is to place them into a vehicle that can convert small beginnings into larger outcomes. This is where many beginners derail themselves. They treat business like a buffet. A little crypto here, a dash of dropshipping there, perhaps a sprinkle of affiliate marketing, and then a sudden shift into coaching or real estate because someone online claimed the margins were excellent. Dabbling feels exciting because it creates the illusion of progress without the discomfort of commitment. Unfortunately, illusions do not compound. The rational approach is the opposite. Select one simple, durable business model and commit to it long enough for competence to compound. Simple is important because complexity increases failure points and reduces learning speed. Durable matters because fads attract competition and collapse margins. A practical business is usually boring to describe and obvious in hindsight. Selling services before selling products, solving local problems before global ones, focusing on revenue before brand identity. These behaviors look unremarkable, yet they consistently work. A person starting from zero should favor businesses with low capital requirements, short feedback loops, and minimal regulatory friction. Service businesses are ideal for this reason. They convert skill into cash without requiring inventory, warehouses, or venture capital. The trade is not glamorous, but it is profitable. Glamour tends to arrive much later, long after the bills are paid and the early compounding has done its quiet work. Choosing one vehicle also eliminates the hidden tax of context switching. Every time attention is divided among multiple ventures, learning resets to beginner mode. Mastery becomes impossible. The world pays disproportionately for mastery and almost nothing for generalized amateurism. The habit of sticking with one path forces depth, and depth is where pricing power, reputation, and defensibility emerge. No one asks the dabblers for advice or pays them a premium. The marketplace rewards those who behave like investors rather than gamblers. An investor asks, "What is the expected return if I repeat this behavior for years?" A gambler asks, "What might happen if I get lucky this time?" The latter mindset is seductive when starting from zero, because luck feels like the only plausible escape. But systems, not luck, build durable prosperity. Systems are simply behaviors repeated over time inside a chosen vehicle. There is also an emotional dividend to commitment. When you build inside one lane for long enough, the world begins to send you opportunities tailored to that lane. Referrals appear, partnerships emerge, and clients return. None of this is random. It is the compounding effect of reputation, and it only occurs when the market knows what it should know you for. A person chasing 10 ideas simultaneously signals unreliability. A person focused on one signals inevitability. From zero, inevitability is the only respectable goal. Pick the vehicle, endure the unexciting early chapters, and let time assemble the advantages that frantic switching will never produce. Investment has become a form of entertainment for the modern citizen. Screens flash, commentators shout predictions, and influencers package speculation as strategy. This turns financial markets into casinos with better lighting. Someone starting from zero cannot afford this spectacle. They must approach investment the way a surgeon approaches an operation, with caution, rationality, and a firm respect for irreversibility. Capital, once lost, is far harder to rebuild than most people imagine. And when starting from nothing, every dollar is a limb, not a chip. The first rule of disciplined investing is to understand that boredom is a feature, not a flaw. Exciting investments tend to be priced for optimism. Disciplined investments are priced for realism. Any proposition that promises rapid returns with minimal risk should trigger suspicion, not enthusiasm. Markets occasionally offer bargains, but they almost never offer miracles. The disciplined investor waits for the former and ignores the latter. Patience plays a central role here. Good investments do not reveal their value on your preferred timeline, they reveal it on theirs. The temptation to continually adjust, trade, upgrade, and optimize may feel like involvement, but more often than not it introduces frictional costs, unnecessary taxes, and emotional errors. Fear and greed are reliable destroyers of wealth, which makes temperament a competitive advantage. A calm mind can earn more money than a brilliant one if the brilliant one is restless. Discipline also requires knowing the boundaries of your competence. Understanding what you don't understand is among the most underrated forms of intelligence. A person who confines their capital to the domains they can evaluate has a structural advantage over the person who believes strong opinions can substitute for knowledge. When you stay within the circle of competence, the odds are not guaranteed, but they are no longer hostile. Starting from zero also changes the required sequence. One must invest first in skills and earning power, then in relationships, then in real capital. Too many attempt to skip the first two steps and rush directly into financial assets, as though wealth can be conjured from ETF or real estate with no underlying engine. Capital without a skill base is fragile. Capital with both is resilient. The disciplined investor seeks asymmetric situations, places where the downside is survivable and the upside compound. This principle works in life as well as in finance. Avoid catastrophic risk. Take reasonable risk. Repeat for years. Catastrophe resets you to zero. Reasonable risk elevates you beyond it. Discipline is the difference between the two. Finally, investment should not dominate your identity. The point is not to look clever, predict markets, or impress spectators. The point is to accumulate advantages slowly, quietly, and rationally until the world treats you differently. Wealth is not built from excitement. It is built from restraint, patience, and the stubborn refusal to do stupid things with money. Starting from zero is not a life sentence. It is simply the condition before compounding begins. Compounding is the quiet engine behind every durable fortune. Yet most people misunderstand its scope. They limit it to money, when in reality the compounding of knowledge, capital, and relationships forms a three-part flywheel. When all three rotate in harmony, progress becomes nonlinear. The early stages appear trivial, even invisible. Later stages appear inevitable. Such is the nature of exponential processes. They mock impatience and reward discipline. Knowledge compounds because curiosity has no marginal cost. Each useful idea you acquire today makes the next idea easier to understand tomorrow. Over time, the accumulation forms a latticework of mental models that help you interpret reality with fewer errors. Error reduction alone is an extraordinary competitive advantage. Most people do not lose because they lack brilliance. They lose because they misjudge situations and misallocate energy. A person who consistently avoids error outperforms the person who intermittently achieves brilliance. Capital compounds for a simpler reason. Money begets more money, provided you avoid catastrophe and behave rationally. The compounding curve is unimpressive in the beginning, a few dollars here, a modest return there. Eventually, the curve bends. Those who gave up early never see the bend, so they conclude the principle was a myth. The ones who stayed long enough discover that time is the most powerful financial force available to the ordinary person. You do not need extraordinary returns. You need ordinary returns sustained for an extraordinary duration. Relationships compound in subtler ways, and they may be the most underappreciated asset of all. A genuine reputation attracts opportunities, talent, and information that cannot be purchased outright. People prefer to collaborate with those who are competent, reliable, and trustworthy. If you maintain those qualities for long enough, you become a magnet. The world eventually arranges itself to help you. It is tempting to credit this to luck, but luck favors people who behave in compounding, friendly ways over long periods. The interplay between these three forms of compounding creates leverage. Knowledge improves the quality of decisions. Better decisions preserve and grow capital. Capital amplifies the scale of future opportunities. Relationships accelerate all of it by reducing friction and expanding the surface area where good things can happen. Eventually, the bulk of your progress comes not from effort, but from accumulated momentum. Momentum is what separates those who are forever starting over from those who cannot be stopped. None of this works for the impatient. Compounding does not respond to urgency. It is allergic to haste and hostile to impulsiveness. It thrives in environments where consistency beats intensity and where long-time horizons replace short-term theatrics. Starting from zero simply means you must endure the slow chapters before the fast ones arrive. That is a fair trade. The alternative, chasing shortcuts and starting over repeatedly, is far more costly. If I started 2026 with nothing, my strategy would not revolve around finding a shortcut, a miracle, or a stroke of luck. It would revolve around doing the ordinary things that work, and refusing to do the extraordinary things that don't. I would avoid stupidity before seeking brilliance. Learn a skill the world actually needs. Live below my means long enough to build a surplus. Commit to a practical business vehicle. Invest with discipline rather than drama, and let knowledge, capital, and relationships compound until the results became too large to ignore. The formula is not glamorous, but it has a track record unmatched by the fashionable alternatives. The world rewards patience, rationality, and competence, not because the world is just, but because those traits compound better than their opposites. Anyone who insists on immediate gratification, endless pivots, or emotional investing will remain a spectator in an economy that quietly favors the patient. Starting from zero is not a curse. It is simply the condition before progress. Most people never escape it because they are in too much of a hurry. They confuse motion with momentum, excitement with strategy, and risk with reward. Wealth, like wisdom, emerges over time from the refusal to do dumb things, the willingness to do useful things, and the discipline to repeat both without needing applause.